The Netflix stock, trading under the ticker NFLX on the NASDAQ, is currently priced at $111.10 as of this reading on Monday, November 17, 2025. That marks a slight intraday movement of negative $41.62, or negative 3.61% for the day so far, trading on a significantly increased volume of 8.85 million shares, much higher than its daily average. The market action is volatile, and to understand this sharp drop, you have to look past the surface-level fear that usually drives these immediate sell-offs. The common expectation right now, especially among retail investors who may be self-investing through platforms like Robinhood or using an individual brokerage, is that the stock is tanking because of the perceived failure of their recent earnings report, specifically the earnings per share, or EPS, miss, and perhaps a general uneasiness following the 10-for-1 forward stock split that just took effect. This immediate decline feeds the narrative that the streaming wars are finally catching up to the undisputed leader. But here is the critical insight. This steep price drop is a massive overreaction to a non-fundamental accounting issue coupled with the entirely predictable volatility surrounding a major corporate action like a stock split. This isn't a business failure, it's a tax dispute that hit the income statement, masking what was otherwise a surprisingly strong operational quarter. The general belief about Netflix Inc., the one that holds the stock's valuation together, is that it's the dominant, irreplaceable incumbent in global streaming, now successfully executing a dual-pronged pivot: monetization of password sharing and scaling the ad-supported tier. This belief drives its premium PE ratio, currently sitting around 46.92. The market was expecting a clean earnings report to confirm this transition, but instead it got an EPS of $5.87, which missed the forecast of $6.89, predominantly due to a hefty $619 million non-cash, non-recurring charge related to a Brazilian tax authority dispute. This is where the deeper analysis forces a rethink. The reality is that without this specific one-time expense, Netflix's operating margin would have been approximately 33%, comfortably exceeding their own 31.5% forecast. The revenue, at $11.51 billion, was in line with expectations and represented a solid 17.2% year-over-year increase. The Street is punishing Netflix stock for a regulatory settlement, not for a deterioration in the underlying business, which is a key distinction that long-term focused investors, particularly those leveraging investment help from services like Fidelity or a Schwab Intelligent Portfolio, need to appreciate. The operational strength is confirmed by the advertising business, which had its best quarter to date, with upfront commitments doubling and the ad-supported tier accelerating its user base and engagement metrics. Looking at the recent stock movement, the negative 3.61% decline today, following the negative 3.64% drop that closed the previous week, is primarily noise amplified by the stock split. The split, which took the price from over $1,100 down to the current $111 range, made the shares accessible to a much wider audience, including smaller retail investors who might be trading fractional shares on platforms like SoFi Invest. While the split changes nothing about the company's valuation or fundamentals, you simply own 10 times the shares at 1/10 the price. It temporarily disrupts technical trading patterns and increases volatility due to the surge in new activity. The high trading volume of 8.85 million shares today underscores this. What's more important than the temporary dip is the consistent upward trajectory Netflix has been on for the past year, up over 34% leading into this recent volatility. Institutional investors have been adding to positions, a sign that the big money sees the strategic pivot working. The subscriber growth metrics, even if not fully detailed in the immediate snippets, showed that the password sharing crackdown and the ad tier introduction are indeed net positive for membership and average revenue per member, or ARM. This is the true tension point. Expectation was for a perfect, clean earnings beat. Reality was a fundamentally strong quarter derailed by a one-time accounting charge, which is a much healthier reality than the stock price movement suggests. The core business model of Netflix Inc. is straightforward: a subscription-based media consumption service delivering a vast, constantly refreshed library of original and licensed content globally. However, that simple model has evolved. The current strategy is a complex, multi-tiered pricing structure designed to maximize ARM across different customer segments. This includes the higher-margin premium ad-free tiers and the lower-cost, high-volume ad-supported tier. The move into live events, such as the massive 10-year, $10 billion deal for WWE Monday Night Raw and high-profile NFL Christmas Day games, is not just about content. It is a critical strategy to reduce churn, the #1 enemy in the subscription business, and to provide a premium, large audience vehicle for their burgeoning advertising platform. Content investment remains a huge, necessary expense, projected at $18 billion for 2025, which, while reducing near-term profitability, reinforces their moat against competition from Disney and Amazon. Older reports, like the mid-2022 slump following the first-ever subscriber loss, force this change in strategy. That crisis moment birthed the current, more financially disciplined and diversified revenue model, moving the company away from pure debt-fueled subscriber growth towards profitable, efficient growth. The lessons learned from that period, like focusing on free cash flow generation, which has been robust, are what makes the current operational performance so compelling, even with the recent tax hiccup. For those interested in self-investing and navigating these kinds of market reactions, observing how the stock bounces back after the panic subsides is a valuable lesson in what constitutes a true long-term threat versus a temporary headwind. The institutional activity remains highly relevant, with major firms using platforms like Interactive Brokers Trading and Fidelity Brokerage for their large block trades. Their analysis is not focused on the daily price swing, but on the trajectory of the ad-supported tier's profitability and the global expansion. Q3 revenue growth was particularly strong in the APAC and Latin regions, confirming that the localized content strategy is working to drive membership internationally. This speaks directly to the business's long-term scale advantage. The current PE multiple is high, sure, which is what the common market narrative fears, but it needs to be seen in the context of their long-term projected earnings growth of over 23% for 2026. This is the market pricing in the exponential scalability of the ad business and the full monetization of the existing 300-plus global membership base. The recent 10-for-1 split, while causing today's temporary drop, is fundamentally a smart move to increase liquidity and accessibility. It makes the stock more appealing for an online investment strategy and for inclusion in various funds and indices, potentially driving demand from new investors engaging in online investing. It also allows individuals using platforms like Robinhood stock trading to buy a full share more easily. Looking ahead, the future outlook for Netflix stock is tied to three major catalysts, all framed by the expectation versus reality principle. The expectation is that the ad tier growth will be linear. The reality is that its growth could be exponential. The ad business is on track to more than double revenue in 2025, moving from a small base to a significant driver. If this acceleration continues into 2026, it fundamentally changes the earnings multiple conversation. The market expects competition to keep margins tight. The reality is that the shift to live sports and events, which are non-streamable elsewhere, creates a unique, defensible moat that its competitors, who are often still dealing with their own streaming divisions losing money, cannot easily replicate. Finally, the market is bracing for ongoing macroeconomic pressures. The reality is that streaming services, especially lower-cost ad-supported options, tend to be resilient in economic slowdowns, as consumers cut the cord on more expensive entertainment. The main risk, which could quickly readjust expectations, is a misstep in content spending, either overspending on a flop or underspending and losing a critical mass of subscribers. Furthermore, a deeper regulatory clampdown beyond the Brazilian tax issue on global data privacy or content distribution rights could impose unexpected costs. However, the operational reality of strong revenue growth and accelerating ad tier monetization currently exceeds the fearful expectations reflected in the daily stock price drop. The 10-for-1 split is a non-event fundamentally, but a psychological one that is creating a temporary buying opportunity for those who understand the core business remains intact and growing. The sophisticated tools and investment help available through platforms like Fidelity and Interactive Brokers Trading are critical for filtering out this short-term noise and focusing on the long-term cash flow generation of a business like Netflix. Let me ask you this. Comment below what you believe will be the primary revenue driver